Every now and then I stumble upon an interesting company to look into and maybe even add to my portfolio. And in this case, I might have stumbled upon one specific one called RH. Yes, that's the name of the company, although the name did change. It has a market cap of just over $6 billion. And yes, year to date has not performed greatly. It's actually underperformed the market. It's up 11.74%. Now, RH was formerly known as Restoration Hardware, and it's a prominent American retailer specializing in upscale home furnishings. RH offers a wide range of products across various categories, including furniture, home decor, children products, outdoor and garden items. Now, I know already what you're going to say. Yeah, okay, great, but quite strange to pick it right now. If we're staying with higher interest rates for longer, if we're entering a recession, isn't that going to hurt a company like RH? Yeah, maybe a little bit, but to be honest, I think their clients are financially settled, safe as well, so I don't think it's going to hurt them that much. Plus, they've been making quite a lot of investments more recently, which is why it has hurt their profitability profile. I mean, if you look at fiscal 2025, the analyst expectation, sales growth of just 4.48% growth year over year, and then EPS actually declining 15.33%. Free cash flow is also negative for the year. If you look at fiscal 26 and 27, solid rebound sales-wise, right? Around 11% year-over-year growth for both fiscal years. And then EPS. In fiscal 2026, EPS expected to grow 114%. And then in fiscal 2026, another 43.5%. So right now, yes, it has a forward PE of 35.1 times. So definitely not the cheapest one out there. But as you can see right here, if you look at price earnings to growth, that's under 1 at actually 0.88. If you look at price to sales, that's at 1.8 times. EV to EBITDA 14.6 times, which is higher than the 5-year mean of 12.3 times. And the forward PE is also higher than the 22.4 times, which, okay, fine. But if this company is expected to grow so fast in the coming 2 years, then yeah, maybe it's worth taking a position right now when margins are compressed. I mean, I've been talking about this actually for a while, especially this year. I'd rather buy a company where they're near the bottom of their down cycle rather than the top, right? Rather than buying companies where margins have peaked. I think buying good companies, of course, it's important to pick the good ones, good companies that have suddenly made changes, investments, and so the profitability profile is down, margins are down. Buying around those prices near the bottom, because you can never time the bottom unless you're very, very lucky, but buying near the bottom usually is a good thing, because when margins suddenly go up, free cash flow goes up, everything goes up, usually the stock price follows. And then maybe that's when you would like to exit if it's not a long-term position. Now I'll talk a little bit more, of course, in this video, what RH actually did do, etc., etc. So if you're interested in that, hit the thumbs up button, subscribe if you have not, and of course, share your thoughts about the company as well, because the first time that I cover this company on the channel. So let me know if you're familiar with it. If it's interesting, let me know down in the comment section below. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. All right, so let's look at RH's performance. So for fiscal 2024, sales has decreased and free cash flow has come down. I mean, it's been a bad, let's say, 3 years for the company, coming out of the pandemic, supply chain issues, investing quite a lot in new areas as well. So that's why we've seen revenue come down, but it's expected to be a little bit better, right? In the last 12 months, revenue is still down 4.3% and free cash flow is actually negative $281 million. Now for fiscal 2025, revenue is expected to grow 4.5%, but free cash flow still negative. But in fiscal 26 and 27, that's when things become a little bit better. If we zoom out a little bit more, we can see actually the big picture right here. We can see revenue going up steadily. Then we've got the pandemic, huge increase, and then a big drop and stabilizing more recently. Same could be said for free cash flow, though we're still waiting for it to stabilize and become positive. Yes, the company has also increased capital expenditures, so that doesn't help its profitability profile, which we can clearly see right here, right? Gross profit has come down since the peak Q1 2022, same for net income, same for operating margin, and the same for gross profit margin. Now, this is in the last 12 months. If we look at quarterly, we can see a small rebound, right? We can see a small rebound in gross profit margin, same from operating margin, same for net income and gross profit as well, which is why you've seen that jump in the stock price since the last report. So yeah, the market is expecting or is hoping that this was the bottom and the recovery has started. If we look at the different segments, so we've got Waterworks, which is basically the baths and the kitchens. It's the blue one that has been growing steadily. So since Q4 2019, that has grown by 51.8%. If you look at the RH segment revenue, that has increased 23.39%. That's the orange line, which has come down but has recovered in the last quarter. If you look at furniture revenue, that is up 36.3% since Q4 2019. That's the purple line. Also, we're seeing a small recovery there. And then the non-furniture revenue, which is the green line right here, was basically stable. Looking at the gross profit of each segment, so we've got the RH segment, which is the blue one, same as we've seen before. Nice run until the top here, Q1 2022. And then we went down. Last quarter, we saw a rebound. Same for the RH segment operating income, same story there. And as for Waterworks, a bit like the revenue, right? We're actually up 93.8% for Waterworks gross profits since Q4 2019. And operating income is actually up by quite a lot, 586%. Now, what did management tell us last quarter? So they said the following: we are pleased to report that demand was up 7% in the second quarter and has continued to inflect positive, gaining momentum each month, with July finishing up 10%. Demand accelerated into the third quarter, with August up 12% and product margin inflecting positive despite operating in the most challenging housing market in 3 decades. Our investments in the most prolific product transformation and platform expansion in our history are now resulting in RH gaining significant market share in North America while building the foundation for a long-term global expansion across Europe, Australia, and the Middle East over the next decade. While our inflection developed a couple of quarters later than expected, we believe the important measure is not the timing, but rather the size of the vector we are creating in comparison to our industry. Vectors are measured in magnitude and direction and can be effective in forecasting strategic separation and future market share gains. It is now clear that our vector is increasing by both measures, as we are outperforming the industry by 15 to 25 points. We expect our performance will continue to gain momentum in the second half of 2024, fueled by our multi-year effort to elevate our product and a multi-decade effort to elevate and expand our platform. Of course, it doesn't help that not a lot of folks want to buy new houses right now because, one, they cannot afford it, plus maybe they're not selling their own house, so they're not going to buy a new one. I mean, it's a very, very strange period of time right now. But hopefully, as rates come down, mortgage rates come down, etc., more and more people will be able to buy new homes. And of course, new homes meaning more clients for RH. And so they continue here. We are pleased that results for the second quarter reflected our guidance, with revenue of $830 million, up 3.6% year over year, adjusted operating margin of 11.7%, and adjusted EBITDA margin of 17.2%. While aggressively investing into a downturn has put pressure on short-term results, it has also positioned RH to capitalize on the longer-term opportunities that present themselves during times of disruption and dislocation. We've seen that with other companies as well in other industries. When you have the luxury of doing this, of actually investing more during the downturn, because you know that you're going to get out of this downturn a stronger company, and so being profitable, being strong, allows you to invest, while other companies are struggling and are barely going to come out of this downturn. They're going to come out maybe the same as before, if not worse, while these types of companies like RH are going to come out of this downturns much stronger. They continue by saying, "We believe our demand performance demonstrates we are the best positioned brand in our industry to benefit from the anticipated rebound of the housing market once interest rates decline and home prices reset lower, closing the affordability gap that has suppressed the market for the past several years." Let's hope that happens in 2025. Now, as for the outlook, they said the following. "As we look forward, we anticipate an inflection of our business in Europe as we begin to open in the important brand building markets of Paris and London in 2025 and Milan in 2026. We are also making meaningful investments to elevate and differentiate our online experience and will be making meaningful upgrades to our website throughout the second half of 2024. And so, despite expectations for industry conditions to remain challenging until interest rates ease and the housing market begins to rebound, we expect our demand trends to accelerate throughout fiscal 24 and into 2025. Due to the extensive transformation of our assortment, we expect revenue to lag demand during the year by approximately 4 to 8 points until we read and react to the new collection, reduce back orders, and shorten special order lead time. Therefore, we will be guiding and reporting both demand and revenue growth each quarter during fiscal 2024 so shareholders and investors can accurately analyze the business. We believe it is also important to note that we are now forecasting to end the year with an increased backlog of approximately $80 to $100 million due to revenue lagging demand throughout 2024, which will negatively impact adjusted operating and EBITDA margins by approximately 100 basis points for the year. Additionally, investments and startup costs to support our international expansion are now estimated to be approximately 230 basis points drag for 2024. To be honest, I like this transparency. It's the first time I'm reading into all of these numbers and all of these reports, but it's nice that when times are tough, when things are challenging, they are giving us more information instead of less. And so, due to our inflection ramping later than expected, we are adjusting our full year forecast for fiscal 24 as follows. Demand in the range of 8 to 10%, revenue growth in the range of 5 to 7%, and adjusted operating margin between 11 to 12%, with adjusted EBITDA margin between 17 to 18%. As for the third quarter, they expect demand growth in the range of 12 to 14%, while revenue growing 7 to 9%, and adjusted operating margin in the range of 15 to 16%, and adjusted EBITDA margin between 21 to 22%. And so looking at the graph right now, it's clear that around 200, 210, that was the bottom. It rebounded around that area twice, which is a good sign. Right now, we can see that the stock did try to go above that resistance, which was around $250 or so. It was rejected before back in March 2024 and here January 2023. Right now, as you can see, the weekly candle, we did try to go over it, but we went under, and now we're also under the 20-day moving average. The 50-day one sits at $310 and the 200-day one at $283. RSI is, well, now with that red candle, has some negative momentum here, but trending towards being neutral. Now, this company, right now, I do not have a position in that company. Maybe if I see another big red candle, another big red weekly candle, maybe I'll start to open a small position if I can see the stock stabilizing a little bit. But to be honest, it's an interesting company, an interesting industry as well. If it did not operate in a more luxurious market, then I would have never covered this, because then there are plenty of other players out there. But since you're dealing here with luxury, it's specific types of clients, then you have specific type of margins as well. Plus, they are expected to expand in Europe, in the markets that you've seen. Those are very, very specific markets that they're choosing. So yeah, very, very interesting. We've covered more and more luxury companies on the channel because I do think that for long-term investors, these are companies that will be solid compounders. Now, of course, this is not a LVMH or a Hermes. No, this is still a $6 billion company, but expected to grow quite quickly, especially bottom line in the next coming years. So that's about it for me in this video. Do share your thoughts down in the comment section below. Your thoughts about this company. Do you own it? Have you ever heard about it? Let me know down in the comment section below. Like, subscribe, do all of that, and I see you all in the next one. Bye-bye.